Excellencies, ladies, gentlemen, thank you very much. The third Gulf Intelligence Energy Forum. I've been given a very specific brief by Sean. No slides, no speech, just tell us what you're thinking about the big effects today on the oil business. And as always with Sean, he's not shy to put some absolutisms on the table, as I call them, sort of some fairly wide-ranging topics. Obviously, it's difficult to specify just a few points of what is on our minds today as an industry. Obviously, there's a massive amount. Syria, Libya, what's happening in Nairobi today with terrorism and the effect on the industry related to that. What's happening today at the UN with the potential new dawn with Iraq and Iran, and the speech by President Rouhani. So there's a lot of different thoughts. There's more mundane thoughts that I think about too. Why are we paying for a handy-sized vessel, 30,000 tons, more than we would to charter a VLCC? How does that make any sense? A VLCC that carries up to 10 times more product than a little handy tanker, and yet we're paying twice as much for that little handy tanker. What's wrong with the industry on that basis? What are we going to do with some of these import terminals for LNG that were built at the cost of billions and billions of dollars on the U.S. Gulf Coast, for example, that will likely never see a barrel of imported gas or a ton of imported gas and will likely be converted to export terminals? What are we going to do with a price of oil that 10 days ago was reaching 118, and a lot of commodity funds and smart money, as it's termed, was buying call options at $130 for Brent in December, and today we're looking at 108 and a very different refining market, at least in Europe. So there's a wide range of topics, and we're going to touch on some of those today, but 3 points I thought I'd make. Firstly is the unbelievable change in the Gulf Coast refining markets on the back of cheap shale and the ability of Gulf Coast refiners to run at levels that we haven't seen in decades and produce oil not only for the U.S. but to export, and the effect that that's had on the whole Atlantic Basin product balance and the shift in incremental crude oil that has traditionally flowed from West Africa, from the Black Sea, from this region, from the Gulf to the U.S. and is today being diverted. Obviously, that's been somewhat tempered by supply disruptions, the lack of Kirkuk, the lack of Syrian exports, recently the lack of Libyan exports, the lack of South Sudanese exports. But as some of those get fixed, we see the dramatic and volatile effect on the market, 118 to 108 in the last 8-10 trading days. It's been fairly hair-raising for all of us. That surge in Gulf Coast refining capacity is also coupled with a big surge in production here in the Gulf itself. You've got a big refinery starting up later this year on the Saudi East Coast. You've got another large refinery in the next 18 months on the Saudi West Coast, and you've got new production in Abu Dhabi, in Qatar. I should say not production, but refining capacity in Abu Dhabi and Qatar. Again, all of that is going to change what has been a net product short market in the region to a long market. Maybe the surge in tankage, Dr. Khalil, in Fujairah will be needed to store some of this incremental production that we're going to see over the course of the next year. I think the second challenge we have as an industry, and to understand the dynamics of it, is the real cost of subsidies. This area has dramatic subsidies. The price of oil above $100 a barrel has a huge effect on national economies. And not only is it the subsidies, but it's the price of oil, which is fluctuating, as I said, over the past 2 weeks, up to 10%. and you couple that with an economy that is struggling and a currency which is being devalued up to 20%, for example, the Indian rupee, and governments having to deal with some very shocking blows to the economy, probably none more so than Egypt today, which is struggling under a $20 billion a year approximately subsidy bill that EGPC has to pay, and clearly is running out of options to do it. It's today being supported by some of the Gulf states, but something has to change, and what is the effect of that on that country and on that economy? Probably the third thing that I think is particularly pertinent and that we can touch on today is the lack of capital in the market for the medium and small size producer. Many oil companies are today valued at, well, let me restart that. Large national oil companies and integrated majors are divesting of their downstream assets and focusing on production, because obviously that's where they get rewarded by the stock market to focus their energy on replacing their reserve accounts on their balance sheets. But the small and medium-sized companies today are all struggling for capital. And we all know the story of the banking crisis, we all know the story of the lack of capital around, but I wonder if it's more than that. I wonder if the forward guidance that we get from the energy markets, and by that I mean unlike the Fed, whose forward guidance probably shouldn't be relied on, but unlike the energy markets, the forward guidance is indicating Brent prices December 2014 at around $100 a barrel, and WTI prices December 2014 at around $90 a barrel, and 2015 prices for WTI are in the mid-80s. And is the lack of money available for small and medium-sized producers because of an uncertainty in the forward value of this commodity? Is it because with shale and with alternative energy, we're seeing incremental production out there that is going to jeopardize or question any capital program we have? We know that the market is changing very rapidly. None of us sitting in this room could have ever predicted 3-4 years ago what we're seeing today in terms of global supply-demand balances, refining margins in Europe that I've already mentioned that have been killed. None of us could have predicted some of these changes. And is that uncertainty translating itself back into the capital markets and the need for those markets to invest in future production? This forum is a unique floor, in my opinion, because A, it's interactive, and B, you will have a chance to participate. And it's one of the reasons why we're very keen to be part of it. I think it's really dynamic, and it's very, very interactive. So these are some thoughts that I've just penned down this morning, and hopefully we'll have a chance to discuss those in more detail. One large factor, obviously, is Iraq and its ongoing production, and it gives me huge pleasure to introduce His Excellency Shahrastani, who hopefully will shed some light on Iraqi production, his view on the oil balances, and his view on the oil market and the energy markets overall. Your Excellency Shahrastani, welcome.